All right, ladies and gentlemen, welcome to Winners, Wallets, and Worldviews, the podcast that teaches you how to be somebody. It has been almost 3 months since I have released an episode. If you guys have been following along on social media or Instagram, I've been really deep in the Venture Project, which is a new co-working space and business incubator that I just launched in Oshkosh, Wisconsin, right downtown. It has been an incredible journey. 7,500 square foot office space that we renovated to look, 1920s Art Deco. It is really, really cool. But it's taken a lot of my capacity and bandwidth over the last couple months. So I was not able to release a couple episodes that we had in the queue prior to the holiday. So folks, if you want to tune in, we've got a couple episodes coming at you the next few weeks, which are going to have a little bit, they're going to be a little dated. They're back probably right before Christmas break, but they are really deep, knowledgeable, tactical episodes. And today's episode is really a pleasure because I had the opportunity to speak with Grant Bledsoe, who is the owner of Three Oaks Capital. It is a financial advising company. He is a certified financial planner. He's also got a degree in applied economics from Ithaca College and an MBA in finance from Ithaca College. We had a phenomenal conversation just on, I'm curious to hear financial advisors, their different views, beliefs, because you get this classic view, which is just max out your Roth IRA, wait till retirement, whatever. But then you get people that kind of understand that finance it's a fluid kind of discussion, and it's about choices and resources and how you allocate your time. And Grant is certainly one of those people that we were able to deep dive one of those conversations. So guys, I really think you're going to enjoy this conversation as we dig into some non-traditional financial strategies that you can employ in your different businesses. So without any further ado, Grant Bledsoe, welcome to the show.
Welcome to Winners, Wallets, and Worldviews, the only show that's going to teach you how to be somebody.
Where in your life did you learn that you're not good enough?
Take what you're most passionate about and what you're most fearful of, and what is the plan to overcome that fear, and what is the plan to enact that passion.
Welcome to Winners, Wallets, and Worldviews podcast. I am your host, AJ Armstrong. You can follow me on Instagram at AaronArmstrong33, or you can go to my website, AaronJArmstrong.com. Joining me, we have a CFA, CFP, Grant Bledsoe, coming from Sacramento, California. We're going to talk all about entrepreneurship, personal finance, and wealth building strategies with the very best. Welcome to the show, Grant.
Thanks for having me. It's great. Do you prefer Aaron or AJ?
I go by AJ to the friends, so that's my kind of subliminal way of knowing if someone's in the inn. Like, oh, AJ, okay, I should know this person and their family and stuff. And if it's like Aaron, I'm like, oh, okay, I can just, we're on the professional level. I call it my CEO name, or my butler name is like Aaron Armstrong.
Can I call you AJ?
Yeah, you can call me AJ. We're friends now. You're on the pod, man.
All right. Well, it's a pleasure to be here.
Yeah. It's funny though. Like, I remember I was doing this experiment with people to find out what your butler name or like your CEO name is. And it's supposed to be your middle name and then the street you grew up on. That's what everyone used to say. So mine would be like John Edgewood. And I thought that's pretty solid CEO name right there. But yeah. What would yours be?
Mine would be Stephen Mount Blanc. Should not be bad.
That's a great. Oh yeah, it's always good. Well, Grant,
there are not too many Grant nicknames, and I used to have a roommate who would call me Grantford whenever they wanted me to get them a beer, and that would be a pretty good butler name too.
Grantford that would be a great one. That could be like that's a strong name. Grant's a great name. I really like that name. Well, welcome to the show, brother. This is exciting to have you on. I see you got a lot of academic credentials in the world of finance, and you're also, a very established entrepreneur. You're a wealth building expert. I want to just hear a little bit about your story. What got you in to the entrepreneurship realm? Where'd you get started? What was your upbringing like? And then we'll just go from there and try and teach people some awesome strategies and tactics they can take away.
Sure. Yeah, I'm happy to. I think my experience in the entrepreneur entrepreneurial field might be a little bit unique because I did start a business from nothing and I'm growing and scaling it, but I also work um, predominantly with business owners and entrepreneurs, helping them they'll build their wealth through financial planning and investment management and so forth. So I do kind of have a flavor of both sides. I grew up in Anchorage, Alaska, of all places, and a lot of people in our family were small business owners in Anchorage. So there was the family business was a dry cleaning company.
Yep.
My dad was an attorney. He had a practice, large practice at one point, small practice at one point, kind of bounced around, and so that experience of being fully responsible for your own income was something that I was pretty familiar with and just grew up around. So I kind of had it in the back of my head growing up that I wasn't sure what field I wanted to get into, but I would really like to head down that path at some point.
Hmm.
I ended up going to college in upstate New York at Ithaca College.
Yep.
I went to play baseball, and you have to go if you think Alaska and you think, well, New York is a heck of a long ways away. It is, because you have to go a long ways to find a college baseball program, and for me, one that was okay, but not so good to where I wouldn't make the team in the first place because I wasn't
Oh.
I wasn't too much of a stud, but I liked playing. So went through school there, played baseball 4 years, had a really great experience. Came out with a degree in economics, and I didn't really know what I wanted to do. And the business school at Ithaca was newly accredited and just kind of getting its feet under it.
Hmm.
And so they gave me a really nice package to stick around for another year and a half and go through their MBA program. So it was kind of hard to turn down because I didn't really have any great job offers at the time, nor a whole lot of direction. So I did that, came out of that experience knowing that I wanted to get into finance and thinking at the time that I wanted to be an investment banker, helping businesses, larger businesses, be bought and sold and obtain public financing and mergers and acquisitions and all that stuff. So I went through the interview circuit for a little while. Didn't end up landing a job. I graduated toward the top of my class and all that, and had really good credentials, but it's just really hard to break into that industry, and I didn't know anybody. So I ended up taking a job at Charles Schwab on their institutional securities lending desk. And I realize as I use those words that that's probably a lot of nonsense to most of your listeners. So I'll spare the technical details, but it's basically a Wall Street job where it's a trading environment. My hours were like 4:30 to 2 every day. So when you're in the office, you're basically chained to the desk because there's a lot of trades, a lot of transactions happening. It's a big room where you're right on top of each other and you have six computer screens in front of you and the phones are going off all the time. And it was an awesome place to cut my teeth and learn the industry. Really high intensity kind of thing. This was back in 2007, right after I got out of business school, right before the mortgage crisis. So I took the job at Schwab. This was in Denver, Colorado. A couple years later, after the dust started to settle from the mortgage crisis, they consolidated the operation. Schwab is their headquarters is in San Francisco, and so they moved me out to San Francisco, consolidated our group a little bit, and I started moving up through the ladder on the team there. So I ultimately spent 7 years at Schwab. Wonderful place, worked with great people who are still friends and I think really highly of. But my journey toward entrepreneurship kind of developed at that point because I'm learning about the industry, learning about brokerage and the investment market. Started picking up a bunch of investing and financial planning credentials and all that stuff that you typically do in the industry, and began to get the observation that there are more or less 300,000 financial advisors, and listeners can't see me, but I'm doing air quotes right now, across the industry. But the vast majority of them, I'd say, back in 2010, 2012, is probably 95%. Today, it's more like 90%, are influenced in some way, shape, or form by either commissions for selling specific products, or secondarily by their own management to do what's profitable for the company, but not very good for the client.
Mhm.
And it's a massive conflict of interest. And it just seemed blatantly obvious to me that if you're someone just with the really basic objectives of trying to do the best you can with your resources, grow your wealth, not have to work up until the day that you die, minimize the amount you fork over to the government in taxes, you should probably be looking for someone who's competent and experienced, but is going to be compelled to act in a fiduciary capacity, which means that if they do something in their interests ahead of yours, you have legal recourse, and it's going to charge you a fair and reasonable and transparent price. Those are pretty basic boxes to check. And that 95% of those 300,000 advisors were not working in that kind of capacity, which is just crazy. It's totally backwards to me. So I thought, sorry, go ahead.
I was going to say, I wanted to touch on this idea of the fiduciary for a moment, because a lot of times when people they hear the word fiduciary and they get this idea that this is someone that's looking out for you and your best interests. But a lot of financial planners know that their clients are looking for that word. And even someone that represents a well-known company, I'll pick on like Northwest Mutual or something like that, they're still trying to sell like their whole life policies, and they're still trying to push these different products, but they label themselves fiduciary because they could maybe trade on other people's products, but they're still incentivized to push their own. I think that's something that's interesting to look for. If you are someone that you hear the word fiduciary, yes, that's something you want to look for, but you want to really test your fiduciary as well to see how independent really are they, how controlled are they by somebody else. What are your thoughts on that?
Yeah, I couldn't agree more. The way that so fiduciary is part of it, and again, you want legal recourse if they put their interests ahead of yours. But again, that's hard to pursue under either arbitration or through the court system. It's a hard case to win. So, secondarily to fiduciary, what I think is also important is what's called fee only. And so what that means is you have a lot of advisors out there, and we can use Northwestern Mutual as an example, that are incentivized to sell whole life policies. And as a financial planner, there is a fact pattern and a person out there for whom a whole life policy is a good fit, but they're very few and far between. And it's very commonly a product that's sold because it's profitable for the company and profitable for the advisor through the commissions that they generate. Fee only means that the only source of revenue to the firm or to the advisor or both is fees paid directly by the client. There are no third party commissions. There are no revenue sharing agreements. There's nothing else happening in the background that you're unaware of. And the whole idea there is transparency. You want somebody who's legally compelled to act in your best interest, but you also want total transparency over what you're paying them and other sources of their compensation. Um, that's another term that's frankly abused by a lot of planners in the industry. They'll say, "Oh, I'm 70% fee only or 95% fee only," and what that means is it's kind of like telling people you're half pregnant. That's not how it works. It's all or nothing. Anything that's not fee only is fee based, which is okay. And I don't mean to denigrate anybody who works under that arrangement, because I know a lot of great planners who do great work at Northwestern Mutual and other places, but um, it's a system that's not set up in the best interests of clients.
Right. And I think another thing to think about too, which you're kind of alluding to, is this idea of commission, of where are the people taking money from? Where is this financial how is this financial planner getting paid? A lot of times whenever I'm doing a deal with someone, a lot of times just even for me to understand in real estate, or if it's in financial planning or whatever it is, I want to know, how do you make your money? Like, how do you get paid? Because that shares with me the motive, and if the motive is symbiotic to what I'm looking to do, then it might make sense for the most part. But if the motive is something different, or I see how, like for the example, Northwest Mutual, if they can get more profit, more commission because they're pushing a certain product, I know that that's going to mess with their psyche. They're not going to be necessarily looking out for the interests of their clients, despite what they tell you.
Totally. Totally. I think it's just an issue of transparency and understanding where the incentives lie. Working on a commission basis, there's nothing inherently wrong with that. It's the behavior that the incentive structure um, supports is the issue.
Yes.
And there are so many. You used real estate. Well, real estate is an industry that I would rather pay someone a flat commission or a percentage of the deal than, an ongoing out of pocket fee or something like that. But it's transparent. I know what I'm paying. I know that the realtor helping me buy or sell is incentivized to get the transaction done as quickly as possible, as opposed to
Hmm.
getting me the best possible price. But that's understood, and we talk about it and work with it. But
Yeah. So kind of back to your story a little bit. It sounds like this idea of being a fiduciary, or this thought of not trying to pressure or push people in one way or another, is what kind of led to your entrepreneurial niche in a way. Can you like kind of keep going on that, I guess?
Yeah, yeah, and it wasn't a totally novel idea. There are a lot of other planners that work in this capacity, but I thought, like, look, I have a pretty good academic background. I've got what are considered, I think, the best set of professional credentials you can have in the industry. The CFA is one that's particularly hard to get, and I have some pretty cool experience and really understand how the plumbing of the financial system works, which is also somewhat unique. Add that to the fact that, again, if you're looking for help with your stuff, you want somebody who's going to charge you a fair, transparent, reasonable price. You want somebody working in your best interests, and you want somebody who's competent, right? That's what anyone who, I think, knows what questions to ask would be looking for. And by and large, that wasn't out there. So it just seemed to be a massive opportunity from where I sat. And that's, I think, similar to pretty much what all entrepreneurs go through. You have a vision of what the world could look like, a way that you can deliver a product or service that adds value to people's lives, and deliver something that helps people and is mutually beneficial and personally enriching. And that was my experience too. So 2007 to 2014, I was at Schwab. I resigned in 14 and started Three Oaks Capital Management to do just that.
You know what's interesting about kind of listening to your journey is something that a lot of entrepreneurs, I would say, struggle with when they're going through this transition from a corporate into a full-time entrepreneurship role. You had kind of mentioned there's basically, I call them your weapons, that your strengths. There's credentials that you have that you've built in the corporate setting or in the corporate environment that you might be able to leverage in your entrepreneurial career. And I think the more crossover there is, that's really helpful. Not to say that you can't just go off and be an artist or something if you decided you wanted to do that, but it's the idea of being able to leverage a lot of your strengths as you move from the corporate setting. And you mentioned you noticed the plumbing about how the financial industry works, right? You knew the ins and outs. You had some significant academic credentials. These are all things that crossed over in a lot of ways, one for one, into entrepreneurship itself. Tell me a little bit about like the crossover, the transition into it, like at a tactical level, what that was like for you.
Sure, sure. Yeah, yeah. A lot of it really did. It's my experience wasn't something where I came up with some really cool new like technology or product and then had to go out there and convince the world that it was valuable.
Right.
It's more of a professional service, and so if you're a
That's
lawyer
still
and
got demand, and it's still, like, just because it's
exactly.
not a super unique thing, there's still a demand and you have the background for it.
Totally, totally. And if you're an accountant and you work for a large firm and you have some idea of it's a little bit different than what happens at the firm you're at, you might quit your job and use your accounting background to start a firm of your own. And that's basically what I did. Financial planning is not as well established. There's not as much history with regard to financial planning when you compare it to like accountancy or attorneys or anything like that. But all that stuff that I learned directly carried over. Now that said, what I was doing at Schwab was I wasn't advising people directly. It was an institutional role. So I was buying and selling, I was borrowing and lending on behalf of Schwab, the big brokerage firm. And what I wanted to do was help individuals and small businesses. And I hadn't done that before. So my skills and experience were directly applicable because institutional portfolio management works really well when you're trying to help people save and invest for retirement, right? That's very, very helpful. But all the soft skills that you develop in, going through an exercise where you're getting to know people, helping them articulate what their long-term objectives are and what they really want out of life and what they need out of their resources to be happy and content, and then formalizing that in a plan that gets them to the best destination for them based on their circumstances, and then helping support their positive decision making along the way to help get them there, is something that was totally foreign to me that I just kind of had to pick up on the fly. And I think like most people who jump into something new, I sucked at it for a long time. I mean, it's a steep learning curve when you're throwing yourself into the deep end.
Right. Well, so tell me a little bit about you working with small businesses in you. What are the strategies that you tend to gravitate towards? I know a lot of times when you're a financial planner, especially a good one, they will be very different. Each customer or client will be a snowflake in a lot of different ways. But what are some of the common themes you see if you were to give some broadcast advice to people that are small business owners or entrepreneurially minded, or maybe they have their own side hustles and they're looking for places to park their wealth or manage it intelligently? Where do you usually go with your spiel?
Yeah, you're right that it's totally different person to person, but I can kind of give you the highlights and a few points I think people ought to consider. If you think about someone working like and this is not to downplay the government or anything like that, but think of someone who spends their entire career working for the government, and they have a nice job, they do great work, they put money into the pension system, and then they maybe save a little bit on the side, and when they hit 65 they quit their job and they collect a pension for the rest of their life. And then maybe you have a W 2 employee at a large corporation that does something similar. And their retirement planning is maxing out their 401k contributions every year, working until they're 65. And then when they quit at 65, they enroll in Medicare, roll their 401k balances into an IRA, and then they have this nice nest egg to live off of for the rest of their life. Small business owners don't swim in that same pool financially. It's a totally different set of circumstances that small businesses find themselves in. And what I find is that, yeah, qualified retirement plans are a really nice way to retain your employees and provide tax benefits, reduce your tax bill on an annual basis. But the value that you have the opportunity to build in the equity of your own business is usually way larger than what you can accumulate in a 401k plan if that's your primary hustle over a long period of time. And so I like to use, the 401k, or maybe it's a SEP or a simple IRA, or a defined benefit plan or whatever, as a tax planning vehicle and an employee retention vehicle. But generally what I see entrepreneurs struggle with a little bit is conceptualizing their long-term planning and realizing that, don't feel bad if you don't put money into a 401k plan. Your ability to keep the business open for the next 15 years is going to be a much larger driver of your wealth than pumping money into an investment account in most cases. So that means that you got to have some cash in an emergency fund if things go south, like 2020 is a pretty good example of that, and just give yourself some more flexibility to keep the business open. Because a lot of people, at least of the size of business that I'm talking to, they're not huge businesses, but if you devote yourself to the effort over a 10, 15, 20, 25-year period, you have something that's valuable and you can sell it for 2 to 5 to $10 million. And
Hmm.
and that is the primary driver, I think, of wealth, if you can manage it appropriately and keep it open and build it into a viable entity that's going to kick off profits to whomever you sell it to down the road.
Yeah,
So think
you're
of the
almost
business as the retirement plan too.
yeah, yeah, and you're almost thinking of, you're taking the idea for a small business owner of taking your business and making the business itself grow is really the ultimate goal with your financial future. And you're kind of positioning yourself almost as like the CFO in somebody else's small business, right? Like where you're just a guy, you've got whatever, and these are the resources we have to allocate. What are some good strategies to budget my business finances, within the structure of the organization, so I can use this as my primary investment vehicle?
Kinda, yeah. And I don't like to position it as the primary investment vehicle, but because we all fall in love with the stuff that we do from day to day, and that concept of diversification, and yes, putting some money aside in other, diversified investment accounts is really powerful too. But I guess my point was that, ordinary financial planning for employees somewhere has to do with putting money into the retirement accounts, saving for their own retirement, giving themselves the flexibility to stop working that job at some point in the future. For business owners, you need to provide yourself some more planning on the person, or some more flexibility on the personal side, to keep the business viable in bad environments. Because if you can, that business can grow to be valuable if you push the right buttons. So here's another example of this that I ran
Sure.
into maybe last year. Um, it was a dry cleaners, coincidentally, that I was talking to, and they're in Oregon. And tough economic time for them. They're getting toward the latter stages of their career, and for them, the difference between putting some things in place to have a viable business to sell and not doing that was almost seven figures. Because if you think of the business as an investment that you're going to hand off to somebody else, you do things like create an operating manual so somebody else can step in. You do things like brushing up your financials, making sure that other people can look through them and understand what's going on. And that's what potential buyers down the road need to give you money for what you've built, right?
Right.
And the difference is, this couple was burned out. They were in their mid 60s. They were ready to walk away. And when they did, they didn't have a sellable entity. And so they closed up shop, they sold off all their inventory, they cleared all their debts, and they just walked away with whatever money was left over, right? If you can put a little bit of effort in there to creating a sellable entity by pushing those right buttons, maybe over a 5-year period before you walk away, you have something that, for in their case, was probably worth between half a million and $1 million, but they just walked away from. So thinking about this whole, financial planning exercise in terms of your business as a driver of wealth is important, and can really give people a lot of flexibility down the road if you do it properly.
That's something I think that's very short-sighted for people in the entrepreneurial realm, at least people that have started seeing some success. Because what happens a lot of times, at least that I run into, is it's very few that someone that goes into a business with the idea of an exit. Usually they don't have like the passion or the grit or the discipline to real that they ever really could have gotten into the business to get it traction enough to get going if they're already going into it with the idea of getting out. So most of the time, more often than not, people get into a business because they're really excited about it, and all of a sudden they hit this point where it's like they're 55 and they're like, what do I do with this thing? My kids don't want it, all this stuff. And if you run into a situation like you just described, where you just decide, okay, we're going to shut down the doors and walk away without being able to salvage any of that business value, it becomes a total waste of potential. To your point, if you can look at the idea of how we can keep this thing operating and grow it into a sellable asset, yeah, this could be money we could sell and use as a retirement vehicle as well.
Yeah, that's very, very well put. And I'm working under the assumption that this is, a full-time endeavor for people, as opposed to kind of a side hustle, and that it's going to take the majority of your time, because that's what it takes to build something into a viable, multi-generational sellable entity. But for people that are in that circumstance, it takes a substantial amount of grind, obviously, and perseverance and risk to get to that point in the first place. I think a lot of people out there just don't capitalize on it once they've already put in those years of hard work.
Yeah, one thing I want to ask you is, there's a lot of people that listen to this podcast in particular that I would categorize as like self-employed. Maybe they're coaches, maybe they're personal trainers, um, massage therapists, hairstylists, that kind of thing, right?
Mhm.
What are strategies for them to do just that, right? How can they continue to grow? Because in a lot of ways, it feels like you're the single point of failure when you're in one of those self-employed roles. But there could be entrepreneurial strategies of how you can grow that, how you can sell that book of business, that kind of thing. What are your ideas for someone like that might be in that situation?
Yeah, you're exactly right. If the business lives and dies with you and only you, you ain't got nothing to sell. The only reason somebody else would be willing to buy what you have is that if the free cash flow will continue after the sale. And so the way that you do that is if you're a personal trainer or I don't know, dietitian or somebody who considers themselves self-employed, we'll start by building a brand and a team around you and start delegating some of the work because your objective is really to remove yourself from the business and have the business stand alone without you. That's what you should be thinking about. And so that doesn't happen all at once. But the key is delegation and creating systems and processes so where you have this big system that provides the services that you're providing now, but without you being in it every single day. That's what's sellable. A really good book there, and I don't know if you've mentioned this on the podcast, is The E Myth by Michael Gerber that talks about building just that. And he kind of does it in more of a franchising type context. But that's really the idea is you got to be able to remove yourself from it. And what coincidentally what I've seen happen before too is if you're self-employed, everything runs in and out of you and you only. And then you start delegating, maybe you hire assistants or other trainers or whatever it is. You build the entity around yourself and then you remove yourself from it. Well, yeah, you can sell it, but all of a sudden you don't want to because managing the business from afar and reaping the benefits and the profitability while not having to do as much of the day-to-day work is just really enjoyable. And you start building the flexibility to pick and choose the stuff that you want to do in the business and just delegate the stuff that you don't. And why leave a business where where you're super happy doing that kind of thing? So
Yeah. It seems like that's a necessary step in order to even grow otherwise, right? Because otherwise
yeah,
your only option is to just keep increasing your prices to a point that it might just become completely asinine based on the amount of value you can deliver, right? Like if you're a personal trainer and all of a sudden you're starting to charge, a couple of like 10, $20,000 an hour, it's like what are you doing? Are you shaving off the fat for them and putting, are you giving them liposuction at this point? Like, what do you really like? You can only really hike the price up to a certain reasonable point, I think. And yeah, you got like
your
celebrity trainers and
your
stuff
heart
like
rate
that.
can only go up so much. Yeah.
Yeah, I know. It's just like eat less, work out
Yeah.
more. Yeah, it's not very complicated. But anyway, yeah, but it's the idea that in order to really grow the business, it's the same strategy to grow the business as it would be to get in a position to exit the business, right? Because if you're that single point of failure the whole time and you just decide to, shut down your barber shop or whatever it is without ever trying to train and grow, that's really something interesting. And I think there is a science, really, as you mentioned, there's just a science to getting systems and processes down to where it maintains the same level of quality. Something like personal training is very difficult because a lot of times there's that personal connection you have with your trainer. That can become something a coach or a counselor might be in a similar position where there's
Mhm.
just like this kind of like personal aspect to it. But maybe there's strategic hiring, right? Maybe there's people you can find as your little protege that's just like you or whatever, and try to get them in the realm and develop their own book or grow their own book and things like that. But I think that's a really good point, and that's a great way of looking at it for people that are entrepreneurial or self-employed and how they can position themselves financially. Another
Yeah.
thing I wanted to talk about a little bit with you is something that I'm not very familiar with. In It floats around a lot of our tons of things I'm not very familiar with, but the one thing, most things I'm not very familiar with, but the one thing that floats around the real estate circles a lot is this idea of a self-directed IRA and something you can use in a real estate investment strategy that you can kind of, it sounds, this is my stupid knowing nothing idea, and I'll let you explain, I guess, more of what it really is. It sounds like it's a basically a tax shelter that you can trade within, but you can't really take anything out until it's like a normal IRA when you're 59 and a half years old, but you can trade like properties, you can buy and sell things within it. Can you explain a little bit more about what that might look like and how that could pertain to some real estate investing strategies? Because a lot of my friends and people listening to this show are real estate investors like me, and we're
Mhm.
always interested in strategies like that.
Sure. Yeah. The self-directed IRA is no different than any other traditional IRA. So IRA is individual retirement account. It's provided, it's in the tax code. The IRS lets us put up to $6,000 a year into an IRA if you're under 50, $7,000 a year if you're over 50, as long as you have that much of earned income. So typically, or traditionally, when we think of that kind of setup, you think about opening an investment account at Vanguard and forking over 6 grand and buying some mutual funds or ETFs. Well, the tax code doesn't specify that it has to be at a brokerage firm in those types of investments. You can put anything into an individual retirement account that a custodian can custody for you. Vanguard, Charles Schwab, TD Ameritrade, they custody stocks and bonds and mutual funds and stuff like that, right? But a self-directed IRA is simply going to a different, unique custodian and getting their help to put real estate into an IRA. So the limitation here is you can't like go buy a rental property with $100,000 and then approach a self-directed IRA company and say, "Hey, I want to put this in a self-directed IRA." You're still subject to those $6,000 annual contributions. This works a little bit better had if you have like 401k balances maybe from a prior employer or a little bit more money already in an IRA, because there is no limitation on moving funds around between IRAs. The limitation is the amount of money that you put in to all your IRAs in the aggregate on a year-to-year basis. So if you've been working for a while and you just left your employer, you've got $75,000 in a 401k. Well, guess what? You can roll that out of the 401k plan after you separated from service, and it could go to Vanguard or Schwab or one of these self-directed IRAs that one of these unique special custodians helps you with. So that's basically what the account is. The benefit of that, just like any other traditional IRA, is that the income, anything that happens in that account, is tax deferred, which is really, really helpful. The downside is that you don't get to capture the depreciation, which is a tax benefit of owning rental properties in the more traditional sense. And when you hit retirement age, which is currently as early as 59 and a half, you can start pulling money out of the account. Anything that comes out of the account is taxable as income at that time. So hypothetically, if you took 75,000 and bought a rental property and you were doing your maybe you built some equity in it, you sold it 5 years later, buy something bigger, it keeps scaling up, or over the course of 15 or 20 years, you might have a substantial amount of value in that self-directed IRA over time. None of those transactions, that buying or selling, is going to be taxable to you, which is really helpful. But everything that you pull out of the account is. And because it's in an IRA, you're also subject to mandatory distributions when you hit 72. So once you're 72, you have to take out a little bit out of the account every year, because since all that money was tax deferred, the IRS is waiting around to tax you on it. They force you to start taking money out of the account when you're 72. So that's a drawback of it, is you have to pull a certain amount of cash out of the account when you're 72. For a lot of people, that means, it could potentially mean, I guess, liquidating a rental property at an inconvenient time to raise the funds to do that.
Sure.
But all the growth is deferred, which is really, really helpful tax wise. The other thing to consider too.
And the reason that why deferred is a great deal is because you're not really making much income when you're older, right? So your income bracket would be lower as you pull out the money instead of just like, if you're making a ton of money right now, right? Is that
Well, planning wise, if you have the choice of putting it into a traditional or a Roth IRA, you can do, I believe you can do self-directed Roths too. I don't see why you couldn't. Um, You would want to structure it so that you're getting the deferral when you're in a high tax bracket, meaning that if you're not making much money now, you put it into a Roth now because you pay tax while you're in a lower bracket. When you pull it out later, you pull it out tax free when you're potentially in a higher tax bracket, or vice versa. Um, the caveat here, though, that does trip people up from time to time is an individual retirement account. You cannot have any incidence of ownership.
Right.
So if you're doing this and buying rental properties, you better not be staying in that rental property,
Right.
because if you do and the IRS catches you, that's a prohibited transaction, and the entire value becomes taxable in the same year, which really sucks from a tax perspective.
Yeah.
So there are caveats.
Yeah, so lot to this. I think this is great because this helps clarify a lot of things for me. Seems pretty straightforward if you had like a traditional Roth account or excuse me, traditional IRA account and like a 401k, you could roll those into a self-directed IRA and you could start using those for real estate transactions if you have a custodian that you can park that with, right? More or
Yeah,
less.
and there are all sorts of regional specialists. We have them in Sacramento. I've got friends in Portland that run a company that does that. So they're around and available.
And so how does this work? I mean, I don't even know if this is even feasible. Can you still get loans on those properties, or do you have to buy these cash?
That's a good question. I suspect you probably can leverage them. I don't see why you couldn't.
I
But
imagine you couldn't
not
deduct interest or anything like you would, but
You definitely can't deduct interest or depreciation or anything like that. Um,
it
but I
seems
don't
like
I
it'd
don't
make
know
a
about
lot
the
of sense
leverage.
for flipping. It seems like that'd be a great strategy if you were a house flipper. You could flip
Yeah.
houses every once in a while. You don't usually take a lot of advantage of depreciation when you're flipping a house because you're doing it trying to get it quick, but you're getting just nailed on taxes all the time when you're flipping a house.
Hmm.
And this seems like a great way where if you're going to do flips, you would want to do that in a self-directed IRA. It sounds like, at least in my opinion. And
Yeah.
then if you were going to just park in rental property, you get so many great tax deals with a rental property the way it is when with that depreciation a lot of times, just miscellaneous things you can deduct on those. I don't know. That's just I'm thinking about it now that you kind of talked about this, and this is just where my brain is going. But I think that might be a great strategy then. So then, okay, so if you have a Roth IRA, that's pretty common, especially someone young in my age. Like for example, I parked a ton of money in a Roth IRA. Can you use that too as a self-directed IRA as well?
You would want to. I don't know. I don't know that you can't. I'm not an expert in the self-directed accounts, but as long as the custodian can set up a self-directed Roth IRA for you, I don't see why you couldn't. Because otherwise, the rules between the traditional and the Roth IRA are the same. What you would absolutely not want to do is take money that's currently in a Roth IRA and put it in a self-directed traditional IRA
Yeah.
and pay a lot of tax twice
You
on it.
twice,
You're
yeah.
you're 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 basically going backwards.
Yeah. Okay. That makes sense. And I think that's a great, I'm glad that you were able to kind of clarify a lot of that for me because I've thought about that as a strategy. Another strategy kind of like that is if you have an HSA account. I've been told, and this is just like in our circle of friends, that you can do the same thing with your HSA account. If you can contribute, I don't know what the rule is, 6,700 or something like that is what you can contribute if you have a family into an HSA account. But you can also do the same thing with that account where you can keep it within and you could use it for properties or kind of direct it accordingly. Is that true as well?
I've not heard of that with HSAs. Um, I don't know that it's impossible, but I've not heard about that. One trick I've learned about recently with HSAs that is pretty cool too is, you know, the HSA, the tax advantages of an HSA, if you're enrolled in a high deductible health plan and are eligible to contribute to one, is better than a Roth IRA. It's the best deal out there because you get a deduction on your contribution now. You can invest the funds, they grow tax deferred. And if you pull the funds out later for eligible medical expenses, they come out tax free then too. So it's triple tax advantaged. And so generally what I tell people is, if you have one of these accounts, let's contribute the max to it every year. But then as medical expenses come up every year, try to pay for those out of pocket and don't touch the HSA money, because we want that to compound and grow long term because it's such a nice tax advantage later. Well, I just learned that there's no time limit on taking money out relative to when the expense actually occurred. So what I mean is that if you have $10,000 in an HSA and you have a $2,000 medical expense this year, pay for it out of pocket, but keep the receipt. And then when you're in your 70s, you can take the money out if you don't have other eligible medical expenses then that would qualify, but you have that receipt in hand from 1972 or 2020 in this case, from years ago, that you can use as a justifiable distribution and not pay tax on it then.
That seems like you'd have to be pretty damn organized to pull that off. I lose shit, and it's been like 2 or 3 days. That's a great.
It takes organization, but that one was new to me this week.
Yeah, that's a great little trick. I think that's great. Yeah, the idea of an HSA is great. And the other thing too that I thought about is, like, if you want to just keep stacking cash in your HSA and you want to live like a freaking king in one of those like senior living facilities the last 3 years of your life, you can just that's what your HSA goes for, and your children or whatever can use the rest of your cash as because I think a nursing home and things like that should be medically qualified, right?
I believe they are. Yeah.
Yeah, these are great. This is great stuff, man. Well, we're digging into it now, but I wanted to we could go on this forever, and we could keep talking about, I think, all the details and different strategies and wealth building. But I wanted to just give an opportunity to our listeners, if they heard one of these different tricks or whatever that they want to learn a little bit more about, or maybe just get in contact with you. How can they get a hold of you? How can they, schedule a consult or anything like that if they want to just bounce some ideas off you or follow you along on your journey?
Sure. So I have a podcast of my own. I have a blog that I write on. The podcast is called Grow Money Business. So go check it out. I talk about this stuff all the time over there. The blog is abovethecanopy.us. I've been writing on for about 5 years. So you can Google that. We've got a bunch of content and stuff. We do monthly webinars on this kind of stuff too, for anybody who's interested. So go over there. We've got a bunch of content. There are areas where you can reach out to me and my team. Generally, my team kind of handles the calendar now and schedules times and so forth. So if you want to bounce ideas off, feel free to reach out. But we've got a lot of content out there on those 2 platforms you can check out too. Oh, and the website for the firm is the number 3 oakscapital.com, 3oakscapital.com.
3oakscapital.com. It's Grant Bledsoe coming at you guys on Winners, Wallets, and Worldviews podcast, talking about winners, people crushing it in life, talking about wallets, personal finance, real estate, small business strategies, and we talk about worldviews, my faith, ideas, and philosophies. Grant, any parting shots of wisdom for our listeners as they continue in their journey of life that you think would be words of wisdom, if you will?
Well, I'm not that wise, to be honest. Do stuff you like. Find ways to, align your values and your interests and your careers, and just keep the ball rolling and try to pay as little as you can in taxes along the way. And if you can do that, you're winning.
I love it. Grant, thank you so much for coming on the show. Once again, folks, you can listen to this episode on iTunes, Stitcher, Spotify, Google Podcasts, YouTube, iHeartRadio, anywhere you listen to podcasts, we are there. I just encourage you all to leave a 5-star review and leave a comment, share it with somebody you think we get great advice or great tips out of today's episode. You just heard it from Grant Bledsoe. You can go to AaronJArmstrong.com/podcast to listen to this episode, as well as to learn anything else about what we got going on. Thank you, everybody. Be somebody.